Okay, my name is Tim, and my channel is called "Stock Market is My Game," and it's very appropriate to. I enjoy the stock market. I'm just an everyday person studying the stock market. I've been doing this for about 5 years, so I thought that I've been saying I've been wanting to do this for about a year now, and I just haven't done it. There's been a lot of roadblocks. I work a lot. Um, so um, I had my son built a little area for me. Last week I tried to do this and the lighting wasn't good. I had to get I found a background here. I'm in my basement and it's not very pleasant. And it was super dark in the basement. So um, I don't have any fancy editing software yet. So I'm doing this on one take. Um, so here we go. The first strategy that I wanted to talk about was a thing called covered calls. And like I said, I don't have any fancy text. Hopefully, I give you content which you understand. What I've done is I've created a slideshow. For right now, that's how I'm going to do this. We do slideshows at work all the time through um, uh, PowerPoint. So that's how I'm going to start this. So I'm going to start this slideshow here. So again, my name is Tim. A couple years ago, funny story. I was always looking at the charts and watching the stock markets and emailing people. And my son had made this chart for me, this shirt for me a couple years ago and gave it to me for Christmas one year. Okay. And it says, Papa's my name. The stock market is my game. And that's the basis of this channel and how I decided that that's what I want to call it. The book I'm holding is a book from my wife. Contacted one of the people that I write to a lot of times or email. His name was Tom Sosanoff. He was the founder, and he started Thinkorswim, and then he started another firm called Tasty Trade, Tasty Works. He's a very good guy. You send him an email, and he'll answer you with questions. So he wants to uh, share what he learns, and that's kind of the intent of this channel. Um, the things that I've learned, I'm hoping that I can share that with you guys. Hopefully you're interested. If you are, please do a like on the the routine. Um, I I like the stock market. One area that I'm really focused on is called options. And the problem with options is it's a very in-depth, it takes a long time to learn. And it took me about a year of studying before I actually placed my first trade. I use different accounts. I did Robinhood for a while. I did Thinkorswim. I really like that platform. I do Trace Trade and I do Fidelity. Okay. And every account I do is I do a different thing, a different strategy. So this strategy that I want to cover in this video is what we call covered calls. It's very simple. So you see here, here's my presentation. So the basic strategy of a covered call is that you buy 100 shares of stock, and the idea is that the stock has a neutral, it's a stock that you own or you want to own. It's neutral to a semi-bullish outlook on something that you think it's not going to go up too far. It's just going to be more neutral. It's not going to go down. Okay. So what you can do is make money on this. So there's a thing called a call. So what you do is you sell a call, and the risk to this is you own the stock. So the worst thing that could happen is the stock go to zero and you lose all your money. But this strategy, the thing that you do is you limit your upside profit. Okay. And that's what I said is something that you think is going to go semi bullish. It's a strategy, and what is the idea here? The strategy is to lower your break even on your stock. Okay, so you buy a stock at a certain price, and you just want to break. You want to break even. You want to lower the cost of your stock, but at the same time is make some money, which the two make are um, basically the same. So I pulled up the definition of a covered call, and you can read that if you want. Basically, but it's a long position. You're buying 100 shares of stock, and you're going to do what they called a sell a sell a call on it. Okay, and this is just showing you the different risk diagrams. I'm going to break that down a little, make it a little simpler. Okay, so here we go. So let me do this first. Okay, the risk diagram of stock here is you buy 100 shares of stock, and let's say you buy it for $100. Okay, um, and there's your profit there. Okay, if 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 the if the value of the stock goes up, you make money. If it goes down, you lose money. Okay, so what this strategy is here is this is a way to lower your price of your stock and also receives what they call premium. Okay, so the idea is to, and this is again the risk diagram. Okay, so what you're doing is you pick what they call a strike. Okay, you just pick something. What you think it's not going to go above. There's different strategy. You can do what they call delta. You can do one standard deviation. And my idea was not to get too complicated in this video, just go over the simple fundamental strategy. And then maybe the next video, I can start talking about different terms in the options world. Okay. So basically what you're going to do is you buy 100 shares of stock, and you buy, or I'm sorry, you sell what they call a call. Okay, sell means that you're taking the risk of the position. Okay, so what you do is you pick a strike price, and I think what I've done here is, there we go. So you bought 100 shares of stock here, okay, at $100. Okay, let's say you pick a strike of 120, and you collect $1 a share, and you receive $100. That's the way this works. So you sell the call. It's denoted by a -1 at the strike, higher than the price you paid to ensure that you make money. So let me go over the basic fundamentals of this. So you buy 100 shares of stock. I repeated myself there, I know. And you buy $120 what they call a strike. Okay, so what happens is you're betting that the price of the strike at expiration doesn't go above this 120 strike. Okay, if it does by 0.01 cents, then what you do is you fork over your 100 shares of stock. But the value, but the thing here is you've bought the stock, you own the stock, and that's your collateral for this strategy. Okay, so you bought it $20 above. You bought the shares, or I'm sorry, you sold the shares, or you sold one strike at $120 strike. Okay, and you received a $1 per share. You received $100. So what happens is, if this stock gets called away from you, you've gained $20 here because you originally bought it for $100, right? You've made $20 here per share, plus you get to collect the premium. So there's a win. Now, the other thing is at the end of the expiration, if the price of stock doesn't exceed the price of the strike that you picked, you get to keep the money that you receive. So you're the one who takes the risk, and that's why they pay you the money. So uh, so what happens if you do this cycle over cycle over cycle over cycle? So the first time you did this, you received $1. Okay, so you lowered your break even to $99 a share. And I show the formula here, break even. The cost of stock minus the premium received, so $100 minus 1 and 99. That's where you get the 99 here. Okay, so so in this strategy is you don't want the price of the stock to drop below your break even, otherwise you lose money. But you got to keep that in mind, and that's what you're willing to sacrifice. Okay, but here's the thing: if you buy 100 shares of stock and it goes down, you still lose money. So you're not really risking anything here, except the 100 shares of stock, okay, which you own. So and if you do this over and over again, you can make money. So here's an example on the one of the platforms that I use. This is the Tasty Trade. Okay, so here's what I'm saying. I did a scenario here where I bought 100 shares of stock. I didn't buy this. This is a scenario. Okay, so you can see here, I bought the shares, 100 shares. I'm simulating here of 100 shares at $27 here. The $27 here. Okay. And right here, I'm paying $26.92 for that's the current rate of the stock, okay, at $26.92. So then at the same time, what I do is I sell a covered call, and I receive $2.98. Okay, so basically what that's done is it's lowered my break even down to here. This is a graph. This graph here is showing you currently what today, if you bought this contract, what your profit is. But if you wait I set this up for 41 days. You see that 41 days here, you can see that I would receive this money right here, which is here, and I get to keep that money. Okay, I get to keep that $2.98. But what they're showing you here up here, this is the profit I would make. Okay, because you got to also remember, not only do I get to keep this money here, but if as the stock goes up, I make money. Okay, so I bought it here, and I bought I sold, I'm sorry, a call option. And what I'm saying is if it doesn't go above 27.5, I'm going to I get to keep this. I get to keep the shares of stock, lower my cost basis. And you can see right here where I lowered my cost basis to, right here, about right here. So this is the same trade right here. It's just on a different platform. They got this is Thinkorswim, and you can see it's the same trade that I did. $23.98, and here's the transaction that would take. You see here that if I do this transaction, they combine this, and I lowered my costs. Remember, what was it? The cost of stock is $26.92. I lowered the cost of my cost basis and actually paid $23.98 for it. Okay. So, and this is the risk diagram, the analysis of that stock in the same platform. Okay. In later videos, I can show you how to get to that that analysis screen. So, I think it's a pretty cool strategy. So here, so what are the outcomes at the end of the day? At the end of the day, at the end of the contract, if the price of the market is above the strike by 0.01 cents, your 100 shares are automatically called from you. Okay. But you've got to remember, you get to receive the premium that you receive, plus you get the difference between what you paid and what the strike was. So you get to keep that. So you win on two fronts there. So scenario two is at the end of the contract, if the price of the market is at or below the strike price, you keep the shares and keep the premium collected, and you lower your cost basis. So then what you can do is do it again. And the third one, if the market goes down really deep, you can take a loss. And that's just, you get to keep the premium, but that's the risk of the stock. Okay. And so there's other strategies you can do, but this is an easy strategy to do if you own stocks shares. So here's my account. And I've been buying when the EV market was going nuts here back 6 months ago for about the last year. And there was this great demand for a workhorse. And there was all this hype, and every week there would be another text or another tweet or whatever, and people would get excited and the stock would go up. So this has what we call a high IV, implied volatility, and I'll cover that in another video. I just want to cover the bases again of the workhorse. I'm sorry, of what a covered call is, and later on videos I can talk about that later. There's all these different things. You've got different things called days, market, trade price, theta, delta, dot dot dot. Anyway, it goes on and on. So what I do is I have been investing in Workhorse, which is, again, it's a EV stock that was there was talk of United States Postal having a contract, and everybody was excited about it, and the price would jump. It jumped all the way up to $30. Okay, so what I did is I started to invest in Workhorse. Okay, so what I show here is this is 100 shares of stock. Okay, each one of these is 100 shares of stock. I should have marked it. I'll have to fix that later on. So I bought this 100 shares and my cost was $15. You know, and you can see that my price here. So I have 600 shares of Workhorse, and you can see that my average cost, I took all this and took the average, and my average is $19.29. That was average. And I just did this a couple weeks ago. I just, hey, where am I on this? And I was kind of haphazard about it. I should have been better on it. So, so then what I did is, remember I told you that you can receive premium for doing this covered call. So what I did is I went back and I said, how much did I receive? And I'm showing that I received almost $5,900 in premium over the last 6 months, since about September. So you can see what I did is I took that premium divided by my 600 shares, and I got this number of minus 9.905. And what that represents is, how much did that lower my stock? It lowered it. So it lowered my cost by minus 9. So what I did is I said, okay, take this number to minus that number, and hopefully that number equals $9.32. So right now my cost basis of those 600 shares is $9. So as long as the stock doesn't go below $9, I'm good. Okay, and my goal is to keep doing this over and over and over and over again until this number gets down to 0. So another thing I did is, a lot of times people do is there's a term called ROC, return on capital. Okay, I've risked so much of my capital. What is my return on my capital? Okay, so here's my deal. I've risked $11,000 of capital, okay, and I've returned $51. I'm sorry, 51%, okay, And you can see that it's this number here, 5,900. That's about half of that. So I've got a return on capital of about 51%. So there's living proof that this strategy works. So again, hopefully this is my first video. I hope that get better. If you like what you hear, please like it or share it with some other people. The intent of this channel is to um, maybe share different ideas for finance. And also, I like motivational talks or speeches or stories or books. So please share this and I'm hoping to do this about once a week or more. So um, I think that's it for now. I've got my daughter working on a small intro. Try to get this more lively. So thanks a lot.